Assalamu alaikum. So, hi everyone, welcome to the class. So today we'll start a new chapter, chapter 8. Actually, it's chapter 8. So we are moving not only to a new chapter, but to a new perspective. Until now, we have seen how to evaluate firms using financial statements or using both financial statements and market data. Now we move toward portfolio management. It's about stocks, it's about bonds, it's about diversification. So actually, we'll try to practice the theoretical notions you have learned during portfolio management course. So we move to chapter 8. Let me just.
Recording in progress.
So I have. I have sent you an Excel file, so please download it. It's a template that we have to use during this chapter. So we'll start basically by the basic concepts of portfolio management, essentially a return, expected return, average return, standard deviation, variance, covariance. Then we'll move to the efficient frontier for a portfolio with 2 assets, and then more complicated issue with a portfolio with n assets. The good thing with this chapter that it will allow you to practice all the theoretical concepts you have seen during portfolio management course, as I told you. So you can practice on Tadawul data, for example. You can build your own portfolio with Tadawul listed stocks. You can maximize your wealth given a certain level of risk, or you can minimize your risk given a certain level of return. So the good thing is we can now practice on real data, and we can learn how to maximize our profits in real world. So let me just share the screen with you. So here we are. That's chapter 8. So in this chapter, we review the basic mechanics of portfolio calculations. We start with a simple example of 2 assets, showing how to derive the return distributions from historical price data. We then discuss the general case of n assets, which is more interesting, but also more complicated. For this case, it becomes convenient to use matrix notation and exploit Excel matrix handling capabilities. So we'll start, the first part of the chapter using just 2 stocks to build the portfolio. We use both Apple and Google stocks as a starting point. So please open your Excel file. So chapter 8 template, this one. So we have data for stock prices for both Apple and Google for the period spanning June 2007 until June 2012. So we have 5 years, but monthly data, right? Which means that we should have something like 60 observations. Let me just check it. See, we have 61 observations. So monthly data. So by the end or by the beginning of each month, we record the stock price for both Apple and Google, right? So we have to use this, this file all along, the chapter. Now, the concepts we have to use, or the basic concepts we have to use for portfolio management, are related to statistics. كلها متعلقة أغلبية بالإحصائيات. So we have to know how to compute the average, the expected return, and the difference between expected return and average. Over average, we use the average for historical data, which means data we have already recorded. سجلناهم قبل. And we use expected return for future data, for our expectations. Then we have to use So average and expected return, both of them are measures for gain, profits. نستعملهم عشان نعرف كام أرباح. But standard deviation and variance are measures for risk. So when you consider an investment, a given investment, when you are about undertaking an investment decision, you have to mix both return and risk to make your decision more efficient. So these are, the concepts we have to use. We have the mean, average, as I told you, have the variance, you have standard deviation, covariance, and correlation. So these are the 5 basic concepts for any portfolio management course and for any portfolio manager. أي شخص، أي مستثمر، يعني خلينا نقول أي محلل مالي، لازم ال5 يعرفهم مثل ما يعرف أسامي عياله أو أسامي أمه وأبوه. But please, you have to pay attention. We have 2 ways to compute these 5, elements. Whether it is about population or sample. So population is when we have all the available data regarding one stock. Since the issue of the IPO of the stock، يعني أول إصدار أولي للسهم هذا until today. يعني عندنا كل بيانات عنه من يوم انولد السهم هذا لليوم. Yes, we have all the historical data for this stock. For example, الشركة السعودية حق البترول، Aramco. So Aramco has launched or has made its first IPO, I think in 2019, right? 2019 صح؟ إذا ذاكرتي كويس. So if we have all the prices of our Aramco stock from its first IPO until now, we say that this is a population. We have all the data, historical data. But if we have just a sample for 1 year, for example, we call it sample, right? في عنا عينة، في عنا كل البيانات. So the way we compute the mean, the variance, the standard deviation, covariance and correlation differ depending on whether it is a population or a sample. The difference is on variance, standard deviation, and covariance. So during the exam, please pay attention, to the way the question is written. You have to pay attention whether it is a population or a sample. The difference is about, when we deflate the number of observations. When you have a population, you deflate or you divide by all the observations, all the number of observations. But when you have a sample, you divide by n-1, right? So this is the main difference. When you have population, divide by all the number of observations. When you have a sample, you divide by the number of observations -1. And this is for variance, standard deviation, and covariance respectively. For the mean or the average and the correlation, there is no difference. We should have the same value. But the difference is when we compute the variance, standard deviation, or covariance. Now, let's get back to our portfolio example. So we have a portfolio built with 2 stocks, Apple and Google. So before starting examining the performance of the portfolio, we should start by examining the performance of each individual stock. خذ كل سهم وحده وشوف وش وضعه. لما أقول وش وضعه، وش معنى وش وضعه؟ يعني كم متوسط الربح الافريج؟ How much is the standard deviation and the variance? And how much is the covariance between the 2 stocks? Because covariance is a statistical measure for the interaction between 2 stocks. الكوفارينس قيس لك مدى تفاعل السهم مع السهم الثاني. We have 2 possibilities. A positive covariance, 3 possibilities. A positive covariance, a negative covariance, and a null covariance equal to 0. When we have covariance equal to 0, it means that Apple and Google are independent from each other. When Apple go up or go down or keep the same level, Google will remain untouched. يعني إذا لقينا covariance صفر سواء سعر أبل طلع نزل ظل ثابت جوجل ما عنده ولا علاقة. يمكن نعمل covariance صفر. When you have positive covariance, this means that the two stocks, both Apple and Google, will interact positively with each other, which means when Google go up, Apple will go up. When Google go down, Apple will follow the same direction. See, even if it is not with the same amplitude, حتى لو كانوا بنفس الكمية بس المهم نفس الاتجاه. إذا جوجل بيطلع سعره بيطلع تلاقي أبل على طول سعره بيطلع. جوجل بينزل أبل بينزل. يتابعوا بعض يعني. Now the third situation when covariance is less than zero, negative. In such case, they have an inverse relationship. Inverse relationship معكوس علاقة معكوس. When Google goes up, Apple goes down and vice versa. When Apple goes up, Google goes down. See? So why am I talking about covariance? Because it is very important concept when you will build your portfolio. Because when you build portfolio, you have to mix both Apple and Google, right? If you are a risky guy, you will choose positive correlation because you will expect that if one of these two stocks will go up, the second one will also go up. So will maximize your profit. Now, if you are prudent guys, شخص حذر, so will be a little bit more pessimistic. تكون متشائم شوي. You have to be cautious. تكون حذر. You will tell yourself, now I have to be on the safe side. So if Google goes down, I have to pick Apple because Apple will go up and will compensate the loss of Google and vice versa. See, so it depends on your aversion to the risk, on your attitude toward the risk. If you express less fear toward risk, خوفك أقل, so you will prefer stocks with positive covariance because you are a guy who is looking for more gains. If your attitude toward the risk is more averse and هياب أكثر من المخاطرة, you will opt for two stocks which are inversely related. Because if one of them will go down, the other one will go up and compensate the loss. So if you look for safety, you will choose negative correlation. If you look for gain, you will choose positive correlation. So we'll see all of these concepts, step by step. So please open your Excel file. So this is the first sheet. So as I told you, we have monthly data. These are real data, by the way, for Apple and Google, listed in the US stock market from June 2007 until June 2012. The first step, and here you have to pay attention, these are prices, guys. These are prices. A financial analyst will make his analysis using returns, not prices. So first step, you have to convert these prices into returns. So this is the first thing that you have to pay attention to during the exam. So I have to, to check if you have directly the returns or the prices. If you are given directly the returns, everything is good. So you can start calculations directly. But here you have prices. You have first to convert it into returns. So we will create a new two columns. So I call the first one Apple APL return. And the second one, Google return. Now, there is two ways to compute a return, whether using the discrete time or using the continuous time. because for and since we are operating within stock market are characterized by one important thing: the prices are available at any time, anytime. So they are available every second. So we call it continuous time. So you can observe the price at any time. That's why we'll use the technique of the continuous time return. We just open using the logarithm. I told you, Hama. So it's a very simple one. Let me just open the board. So we have learned that when we look to compute the return for a price, for example, or for stock, so the return are at one date, T, for example, is equal to the price at that date minus the price at the previous date, right? Divided by the price at the previous date. So this is the way we compute a return, right? But this one is good for discrete time, which means that we observe data intertemporally, which means we observe the data today, and then we observe it once again by the end of the day of tomorrow, for example, and so on. But between these two dates, we cannot observe data, called discrete. But if we can observe the price at any time, we call it continuous, which is the case for stocks. Because if you open, at any, during, the trading session, you will observe the price live, right? So for this one, we use RT becomes equal to the logarithm ln, the Neperian logarithm, because we have decimal logarithm and Neperian one. This one is Neperian logarithm. PT divided by PT minus 1. So we use this one for stocks. الآن هذه اللوغاريتم Neperian logarithm. No, we get slightly different results. Every time the lapse of time كل مرة يكون فيه يعني الفارق الوقت between two observations is too large. The difference between the continuous and discrete becomes also too large. That's why for stocks use always the continuous time. All right. So, but pay attention to the order of the numerator and denominator. At the numerator, we use PT, which is the current time, the most recent time. At the denominator, we use the previous date, right? Why I'm focusing on this, particular point, because it is one of the most, common mistakes made by students during the exam, and it can literally ruin all the exercise, all the exam. أقول لكم ليش. So suppose now I'm trying to compute the return for Apple, right? So I will use equal ln, which is the logarithm function, right? Then the price of Apple by the price of Apple next month, right? And click on enter. I have minus 0.076. I can transform it into percentage, sorry, and add more decimals. So minus 7.66%, which means that between these 2 months, the price of Apple has driven down. يعني كانوا غطس تحت. بس ركزوا معي، احنا سوينا هنا. عكست هنا. Absolutely. So I should start from July, not June, because July is the most recent date. Right? So if you use this one, if you don't pay attention to this particular point, it will find negative returns, while the return is positive because the price of July is higher than the price of June. So to pay attention to this particular point, please always check the dates here. Check the order. شوف ترتيبه. So I have to rewrite it. So ln.
And also starting from next cell.
So C divided by June. Now, if I do this one, there's another mistake also because I should start in July, not June. So I have to sacrifice, you have to always sacrifice one row, whether it is the first row or the last row. It depends on the order of the observations. So I will write it once again. So equal ln. So see, July, the most recent month, divided by June. Then I'll scroll it down, see here. So for example, I put the pointer here. So B4 divided by B13. So this is B4 August by July and so on. So I don't have to repeat it for all, the cells. So I have just to put the pointer here, have the plus sign and double click on it. And it will automatically compute all the returns for the remaining data of the series. Now do the same thing for Google. Price of July divided by the price of June. And then double click. So we'll use these new columns to continue our analysis. The returns, not the stocks prices. Now here we have to compute the monthly mean, the monthly variance, monthly standard deviation. Then we have to convert them into annual mean, variance, and standard deviation. So we start by, so I will insert a new row here. I call this one Apple. And this one Google. Now for the monthly mean or the average, it is simply equal to, see, I can use the average function already, used by Excel. I have just to see here to select the data for Apple returns.
Mean return.
Average.
Mean average.
هي نفس المين هي الافرج.
Not the geometry.
No. The arithmetic one. 2.61%. And then I can just scroll to the right hand side here. And I'll get the average from EC, E14 to E73, which is the average mean or the monthly mean return for Google. This is the formula text here. Now, the monthly variance and the monthly standard deviation, right? So we'll start by the variance. So it is clear here that we have just a sample because both Apple and Google exist way before 2007, and they exist way after 2012. So it's clear that we have just samples here. So we go here, use equal variance. So see, have var.p and var.s. P for population, S for sample. So we use sample. Same thing, we have to select the returns. And then scroll it down to the other side. Equal formula text. So it is way, faster and safer than the, traditional technique to use the variance, because for the variance, we have to compute all the returns, then the mean of the return on deviation compared to the return, to the mean return, sorry, don't, the square, then you have to divide by number of observations. It's a long process and you can make a lot of mistakes. But here you can use Excel and you get the right answer directly. Now, the monthly standard deviation, we have two options. So standard deviation is simply equal to the square root of variance, or we can use standard deviation functions here. So we have two, same thing, dot P dot S. We have a sample, we use the S. We select all the data. See, we can solve it in a matter of seconds instead of using the traditional way and lose a lot of time and energy. Now, second thing, because in finance we always use annual statistics, so we have to convert these monthly statistics into annual statistics. Very simple. So for the mean, we have monthly mean, and since we have 12 months per year, so we have just to multiply the monthly mean by 12 and we get the annual mean. As simple as that. So we go here for Apple is equal to the monthly mean here multiply by 12. That's it. Now for the annual variance, same thing, you have to multiply by 12, but for the annual standard deviation, you have to multiply by square root of 12. So we have to pay attention to this particular point also, because the standard deviation is nothing but the square root of the variance, right? So to get the annual variance, you multiply by 12, which means that when you move from variance to standard deviation, you have to apply the square root. So for the variance, still equal to, the monthly variance times 12. Then for standard deviation is equal to the monthly standard deviation now times square root of 12, not 12, square root of 12. So it becomes clear here that during this period of 2007, 2012, Apple is by way more performant than Google, because Apple is offering higher positive annual mean return, 31% per year, which is a huge amount, huge return. So imagine that you have, invested your money into Apple stock, starting at 2007. And after 5 years, you will get a compound return of 31%, which means for the first year, your investment will grow up by 31%. Now for the second year, your initial investment plus the increase, both of them will increase by 31% and so on. So actually, when you invest $1 in Apple, after 1 year, you get 1 times 1 plus the annual mean, power 5. We invest $1, you get $3.9, almost $4. You invest $1 million, you get $4 million.
At the end of
the 5th year, right? So I have put power 5, because this is the annual mean of return. each year your investment will grow up by 31% and so on. Now, this is your first step. Okay, so you have to characterize each one of the individual stock that you have to use afterwards for your portfolio management or to build your portfolio. Now, your second step, as I told you, is to compute the covariance and the correlation to see how these two stocks will interact with each other. شلون يتعاملون مع بعض؟ لأنهم اثنيناتهم من نفس القطاع ترى. هل يتكاملون مع بعض؟ هل يتنافسون مع بعض؟ هذا بنعرفه عن طريق الكوفارينس والكورليشن. So this is how we compute covariance and correlation, right? So we have the same stock returns for Apple and Google, same period, right? Now, there is two ways to compute covariance and correlation. The traditional way, using statistical formula, or using Excel formula, right? So here is a demonstration here, a very good example here, about the difference between covariance for population and for sample. Let me just be more clear. So for example here, see, we use the population covariance.p. So we have a covariance of 0.001956. Now when we use the covariance for sample for the same data, we get 0.001989. See? Which is different. So when it comes to investment of millions of dollars, the difference is huge. So that's why you have to pay attention of the use of population or sample technique. All right. So anyway, so we'll see all these differences step by step. So here we have the data. Now, your goal is to compute the covariance and the correlation, see, using both population sample and using sample technique. See, for example, for the correlation computation here, we have the same result whether you use the population or the sample. So the only difference between P and S is about standard deviation, variance, and covariance. But for mean and correlation coefficient, you don't have any difference. يعني قلنا عنها 5 أشياء بنحسبها صح ولا؟ الافريج، المتوسط، الفارينس، standard deviation، covariance، correlation. حلو؟ في الخمسة هذول في 3 بيتأثرون إذا استعملت البي أو الاس اللي هم الفارينس، standard deviation، الكوفارينس. الاثنين الباقيين اللي هم الافريج اسمه والكورليشن ما يتاثرون. سواء استعملت البي او الاس نفس النتيجه. نشوف الحين. So let's start. So I will open new sheet. Call it sheet number 2. So to save space and time, so I will just see here. So I will here. I will copy all these data. And go here. And I will use special paste. So I'll just paste the values. So see, paste values, see, paste values. So I will delete Apple and Google prices because we don't need them anymore. We have just, or we need just the returns. So I have to compute the average, the variance, standard deviation, and covariance computation. So we have the average, sorry, put here Apple, here Google, start by the average, the variance, the standard deviation. So let's start by the sample technique. So for, as I told you, for the average, we don't need, we have the same result whether for sample or for a population. So average for Apple, then you have the average for Google. Let's transform them into percentage and add decimals here. Now the variance. Now let's start by sample. Sorry, not covariance, variance. هنا variance S Google, and finally standard deviation S Now, if I decide to use the population technique, so here, as I told you, we keep the same average, but the difference is about, or is for variance and standard deviation. So we go the variance here is equal to, instead of P, S, I will put variance P, Apple returns, see there is slight difference between Apple variance for the sample and Apple variance for the population. Same thing here for standard deviation for the population. And we move to Google. So here the formula text.
It's for population.
So yes, the second one for population, the first one is for, see here, for the samples. Okay guys, واضح بنات. طيب now it depends on the question itself. So it will be, clearly mentioned if it is a sample of observations or all the available data. So if he told you all available data, use population. If he say sample for a given period or for a given window, use sample, right? وشو؟ ايه بس هذه ما تعطيك اكثر دقه. الوقت اكثر دقه population واسمه والسامبل، هذا تعطيك اكثر دقه. طيب اللي بعده الحين قلنا الكوفارينس. الكوفارينس فيها طريقتين. So for the exam he can ask you to compute the covariance using two techniques: statistical technique or using Excel. So the statistical technique is about شو? Yes. So because during the exam he can ask you one of these two techniques, statistical one or Excel. So this is the covariance between two series X and Y. X and Y are two random variables. Is simply equal to 1 by n, the sum xi minus x bar, sorry, not squared, times y bar, yi, sorry, minus y bar. So it's for the whole population. For sample, you would divide by n minus 1, right? So for our example, x is the return of Apple, while y is the return of Google. So you have to build a new two columns. The first one is the deviation between each Apple return and the average. Then second column, the deviation between each Google return and its average. Then third column, you have to multiply both of them. You have to compute the average for these, new, components. Then you get to the covariance. So let's see how to do it. So this is the textbook. See here. So you have to return minus average for Apple and for Google. You have to multiply them both, the product, right? And then you go to covariance here and just the average of these product column, and you get automatically the covariance. So this is the first technique, using, the statistical technique, and then you can use the covariance piece. So for this, let me just this technique. See the average. We assume that we use all the data, which means this is the covariance for the population. Then I will show you how to use it for the sample. Now, let's get back to our, see here our Excel sheet. So I will create two more columns. I will call them, for example, here Apple deviation, and then Google deviation. And then the product. So I told you, so we have to see here, we have to, sacrifice the first row. So we start from the second row. So by Apple deviation, I mean the deviation difference between each observation and the return and the mean, sorry. So equal Apple return here minus the average for Apple. Exactly. So since the average is constant, I have to add the dollar sign for the average cell. And then I can scroll it down And repeat the same thing for Google. So equal to the Google return for the first month minus Google average return, add the dollar sign for this average return, and then see. So same thing here, 5.05, 10.99. Last one are minus 0. So minus 1, 53%, and 11.2%. See? So we have the right results here. Now, the product, the deviation of Apple, times deviation of Google, and then scroll it down.
What is the product?
You have to multiply the Apple deviation by Google deviation. This is the formula text. Now, the covariance. So how to compute the covariance between Apple and Google. So first technique is the average of the product column. So average of the all data in the product column, 0.20%. So I can add decimals to be more. 0.1956%, which is 0.001956. Same result here. I can convert it into number. And this is the formula text.
This is covariance.
This is a covariance, yes. Which means that Apple and Google are slightly, very slightly positively correlated. It's almost zero, right? So they are almost independent from each other. It's a good thing when you are trying to diversify your, your portfolio.
Okay. Use covariance formula.
Yes, absolutely, yes. Yes. So if you use the covariance formula directly, so we go here. So it's a statistical, one. So I call it covariance here, for example. So I use as if I have a population, right? Not a sample. So P, so go here, equal covariance. You have P and S, see? So now for P and S, you have to select the two series. See, we have array 1 and array 2. You have to select the returns for both Apple and Google.
Why are you using population?
Because we assume that we have population. Then we'll see how to compute the S sample covariance. So we go here, see, we select both Apple and Google returns. So I start by Apple, see, first array, then comma, then I go to Google return. So as if I'm giving instructions to Excel to compute the covariance between the first series should be 3b62 and the second one C362. So as I'm telling him, we have two random variables, and I'm asking him to compute the covariance. See, same result. Everything is okay?
But you don't take that mistake, which is I take product instead of project. No, it's not. I use calculation. So, okay.
كنا وصلنا نفس النتيجة. Yes. لا والسامبل هو مور اكيوريت، هو اكثر دقه. لا لا مو مور اكيوريت، احنا بس ودنا نوريكم الفرق بين بوبوليشن والسامبل، ما اعطيكم نفس النتيجه بس ما قلنا هذه احسن من هذه. لا طيب في واحده ثالثه بعد. there is a third So now you can also use directly a function called covariance, right? Without adding the p or the s. If you use the covariance, it will automatically consider this data as a population. All right. So we have covariance here once again. This is third technique. So see, you use covariance. Sorry. So covar. No. So upper return. And then Google return. So you get the same result. So if you use the covar function, it will automatically consider this data as a population. Now, for the sample. So how to get the covariance for a sample using the statistical formula? So I told you, we have to divide by the number of observations minus 1, right? So instead of using the average, you have to sum up all these elements here in the product column, and then divide the sum by not 60 observations, because you have 59, right? So 59. So 0.0019891. See, same thing.
This is for sample.
For the sample, right? So this is for the sample. And this one is for population. See, because we have 60 observations. See, so we have the count here is 60. So we have to use, for example, n-1, which is 59. So we have to sum up all the cells here in the product column and then divide by 59. Or we can use directly the covariance S and then specify the Apple return and then Google return. And that's it. So there is a slight difference between the two numbers, whether we consider a population or a sample.
The covariance reflected as a number or percentage?
As
Covariance.
doesn't matter. The most important thing is we have to check if there's higher than 0, lower than 0, positive or negative. Now, the final statistics is the correlation. So the correlation is equal to the covariance divided by the product of standard deviations. For example, if I want to compute the correlation between two variables, x and y, is equal to the covariance between x and y we have computed here, divided by the standard deviation of x times deviation of y. Now the correlation is always between -1 and 1. It can never goes lower than -1 or above 1. If correlation is equal to 0, it means the two stocks are totally independent. If it is positive, there is yes, but now if it goes toward 1, there is a strong positive relationship. If it is equal to 1, means that these two stocks will move in the same direction with the same steps. So if one of them will go up by 10%, the second will go up by 10% also, when rho is equal to 1. Now, when rho is equal to -1, means if one of these two stocks will go up by 10%, the other one will go down by -10%.
Because that means the correlation equal to 0.8.
Now, for 0.8 means if the first stock will go up by 10%, the other one will go up by 8%. So they keep the same direction, but not with the same steps. بنفس السرعة بنفس الخطوات. Now, this is the way to compute the correlation, or there is a second one, you should directly using Excel function, right? So the correlation coefficient, so it is equal to, now you will see that whether we use covariance P or covariance S, we should have, or we must have the same correlation coefficient. It's independent from, the way we use, we have computed the covariance. So it is equal to the covariance P, for example, here, divided by the sum, the product of standard deviation of Apple. So we use the P here by the one of Google. 0.1760, which is a slightly positive relationship.
You are using the covariance for population, but standard deviation for sample.
No, for both population. خلينا نتأكد بس. So it is F11, see here, for population, divided by F8, this one, for population also.
Population.
Yes, G8. Now, if I use the sample statistics, so equal to covariance S sorry, divide by standard deviation of sample times standard deviation of sample for Google. See, we get the same result. So for correlation, so there is no impact on population or sample on the statistic. Or we can use, see here, the correlation function. But here we have to, specify the two arrays or the two vectors, the one for Apple return and the other one for Google return. So we go here. So I have Apple return here. Then Google return and close the parentheses. Still get the same result. So these are the different techniques to compute the covariance and the correlation between two stocks at least. Now we can build our portfolio, and now we can measure the performance of our portfolio because we have all the necessary data. We know the expected gain for each one of these two stocks. We know their respective level of risk, and we know how they interact with each other when put together. Now we can build our portfolio. Okay, guys? So suppose our portfolio will be composed by 50% of Apple and 50% of Google. So suppose you have $1 million. So we'll invest $500,000 in Apple and $500,000 in Google, right? And then see how our portfolio will perform. So same thing, we have to compute the mean return, the variance, standard deviation. So we have already computed the covalents. So these are for Apple and Google, so already done. Now we have to compute the mean return, the variance, standard deviation for the portfolio. So every time you have to characterize or you have to measure the performance of your portfolio, you have to do it by computing three elements: mean or average, variance, and standard deviation. So these three numbers will give you insights about how good your portfolio is doing, right? So as I told you, we have already computed the Apple, Google statistics. So we go here. I will open a new sheet. I call it portfolio. So I have Apple and Google. Here's the proportion invested on each one of them. So Apple is 50%, while Google is the complementary proportion, which is 1 minus. So please do not type 0.5 for Google, right? Always make the proportion of Google a function of the proportion of Apple. Make them interrelated. I will explain you why afterward. يعني في الاختبارات يقول لك مثلا if they told you during the exam you will build the portfolio with 30% of Apple and 70% of Google. On your Excel sheet, do not type 0.3, sorry, and 0.7. Do not do this. Don't do this. Instead, say type 0.3 here and make the proportion of the second,
1 minus.
yes, 1 minus. Make it a function of the other proportion. So equal 1 minus. It's very important. If you don't do this, you will get a lot of trouble when you have to build your efficient frontier.
Let us using the 3% with 7%.
طيب ما في مشكله. خلينا نجرب بعدين. احنا اصلا بعدين بنسوي الداتا تيبل بنغير فيه كل شيء. يعني بنلعب فيه لعب بالبروبورشن يعني. طيب. So we already know the characteristics for Apple and Google. Since we know the mean, the variance, standard deviation, and the covariance between these two stocks, right? So البيانات اللي عندنا. Just to see here, I will copy them, go to portfolio, and as usual, I will make special paste, just paste values. And I will add the covariance here. And sorry. And the correlation coefficient. So I will use the sample one, covariance sample, this one, copy, and go here and just paste the values. And finally, the correlation, same thing. جبناها من الصفحة اللي قبلها. بقول لك لأنه لما نحتاج بنحاول نحسب الفارينس حق البورتفوليو بنحتاج الكوفارينس بين ابل وجوجل، عشان كده بنحتاجه. Now, as I told you, we have to characterize the portfolio. By characterizing, I mean computing the average, the variance, and standard deviation. So this is a portfolio. I have to compute these three statistics for the portfolio. Now, we know.
Instead of average, we use the mean.
Yes, so the average is mean. So we know that the average is a linear function, which means if I build a portfolio with both X and Y, right? The average return of this portfolio is the weighted average of both X and Y. Let me explain you. So here we have portfolio P, right? So P is composed by 50% by Apple and 50% by Google. This simply means that the return of the portfolio, the average return of the portfolio, is nothing but the weight invested in Apple, which is 50%, times the average return of Apple, plus the weight invested in Google, times the average return of Google. متوسط weighted average اسمه متوسط مرشح موزون. We already know the return average of Apple and Google. We know the weights عن الأوزان, so we can easily find, the portfolio return. Now for the variance, things become a little bit more complicated. If we want to use or to compute the variance of the return of the portfolio P is equal to the weight invested in Apple, 50% squared, times the variance of Apple plus the weight invested in Google squared times the variance of the return of Google plus 2 times the weight invested in Apple times the weight invested in Google times the covariance between Apple and Google. We know the variance of Apple, Google, and the covariance, so we can easily find, these numbers. Or
There is no function. There is no function about portfolio variance.
no. Or you have to build a new column called the portfolio return by using the portfolio of Apple and Google, and then you can use the variance function directly. We'll see it later on. The second technique using the correlation. So the variance of the portfolio is equal to, same thing here, 50% squared times the variance of, called Apple, plus 50% squared times the variance of Google. Now, plus 2, 50% times 50% times the standard deviation of Apple times the standard deviation of Google times the correlation coefficient between Google and Apple. لأن هدول الاثنين مع بعض هتكون covariance. So you can use it with covariance directly or using the correlation. Now let's try to apply this formula using Excel. Let's go back to Excel. So start by the average. So the average of the portfolio is equal to the coefficient, the weight for Apple times the average return of Apple plus weight of Google times this is your formula text. See, I'm just writing this formula using Excel بس. سهل. شوف اخذنا البي 2. شفت البي 2 اللي هو وزن مستثمر في ابل، صح؟ ضارب الاي 2 اللي هو متوسط عوائد ابل، بعدين زائد كم استثمرنا في جوجل 50%، ضارب اف 2 اللي هو متوسط عوائد جوجل. يعني احنا طبقنا هذه بالضبط يا محمد. هذه شفت هذه طبقنا كتبناها اكسل وبس. Now, a little bit more complicated, the variance. So the variance is equal to proportion invested in Apple power 2 times the variance of Apple plus the proportion invested in Google power 2 times the variance of Google plus 2 times proportion invested in Apple times proportion invested in Google times the covariance between Google and Apple. Standard deviation is simply equal to the square root of the variance, and that's it. So equal square root of the variance.
I have a question here.
Yes, please. Go on.
There is an explanation for standard deviation related to $1. Find this $1 and this project.
No, the standard deviation is about the return. نحكي على الريتيرن، نحكي على الفلوس، نحكي على الريتيرن، صح؟ شو الكلام هذا؟ on average you expect to gain 1.80% each month, okay? But there is a risk that the realized return will be up or down this average by 8.16%. So that's why this is a pretty risky portfolio, because the standard deviation is pretty high compared to the average. انت الحين في البورتفوليو هذا في المتوسط تتوقع راح تكسب هنقول 1.2% كل شهر، صح؟ بس في احتمال انه اللي راح يصير يكون اكثر او اقل من انت متوقعه ب 8%. اذا انت اصلا يعني 4 مرات اكثر من متوقعه انت. مره يعني هنا الديفيشن مرتفع. ماخوذه من لا، ماخوذه من حق ابل وجوجل مع بعض. شو يتحركوا مثلا هنا، تاخذ شوف ابل مثلا هنا مره 7%، مره 5%، مره 10%. بصفه عامه هنا 11.17% في تذبذب في سعر ابل. 11.17 هذا سعر ابل وحده. شفت؟ يعني وش الحكمه في البورتفوليو؟ ركز معي الحين. تحط فلوسك في ابل، كم تكسب منه؟ حلو. كم ستاندرد ديفيشن؟ طيب تحط فلوسك في جوجل تكسب كم؟ تخسر. وكم الستاندرد ديفيشن؟ شفت؟ لما دخلتهم مع بعض في البورتفوليو كم يصير المخاطره حقك؟ 8%. واضح؟ لانك تحط فلوسك كلها في ستوك واحد بس في مخاطره اعلى. لما تسوي دايفرسيفيكيشن تنوع، وش تلاقي هنا؟ المخاطره حقك اقل وتكسب بعد. واضح؟ ال 8% قلنا اذا استثمرت فلوسك كلها في ابل وجوجل مع بعض.
يعني اسوء سيناريو اذا 8 انكسر كم العائد؟
حق يصير عندك ماينس 7 بوينت كذا برسنت، تقريبا ماينس 7% تقريبا. شيل من 8.16 تقريبا يكون عندك. ترى هذا ستاندرد ديفيشن، بس في بعد بنسمى الاكستريم فاليوز انت اكثر من كذا بعد. راه اذا في المتوسط يعني هذا تذبذب بالمتوسط، بس اذا بتروح يعني في الاكستريم في يسمى التيلز حق الديستريبيوشن او اطراف الديستريبيوشن، تلاقي نفسك تخسر بعدين خسائر كبرى. يسمى الفاليو يقيسوها بالشيء اسمه الفاليو ات ريسك. هذا شيء ثاني تقرا في مانجمنت، في ريسك مانجمنت. بس خلينا ناخذ الحين بريك وبعدين نواصل ان شاء الله بعد 10 دقائق. كويس؟ بريك. اي صلوا بس 10 دقائق ونرجع ونرجع بعدين ان شاء الله. الله يعافيك. السلام عليكم. So let's resume our class. So as I told you, we have first identified the characteristics for individual stocks. Then we have to move to the characteristics, for all the portfolio. Okay, guys. And that's what we have done just before the break. So this is the portfolio. This is the average, the variance, and the standard deviation. But this specific result is conditioned by the proportion invested in Apple and Google. So if we modify, for example, if we decide to invest, for example, 30% in Apple instead of 50%, see, so 0.3, sorry, see. So the characteristics of the portfolio will completely be different. If you want to invest, for example, more in Apple, let's say 80% in Apple, still have differences, right? So every time we'll change our, proportion invested in each of one of these stocks, it will be, a modification into the portfolio performance. Now, how to find a way to summarize all these, possible, let's say, combinations between Apple and Google. So we can build data table. See here. So this is when we have 50% invested in Apple. Now, this is when we modify our investment in Apple, and by consequence, our investment in Google. So there will be different standard deviation for portfolio and different portfolio mean return, right? So we can go here. So we'll build data table. So we go here. So we'll build a data table. Now pay attention. We have to start first by standard deviation, because as we'll see later on, when we have to build the efficient frontier, the standard deviation is the x-axis and the return is the y-axis. So we have to place the standard deviation first. So please pay attention to this particular point. We have to start by the standard deviation. Now, here we have Apple proportion. Then we have the portfolio called PF standard deviation. Then the portfolio mean return or average. So equal. Okay, so Apple proportion here, standard deviation of the portfolio, and the mean return of the portfolio. Now go here. So equal, and you go to the standard deviation formula. See, you click on it, B13. Enter. Then the portfolio mean, which is B11, is average portfolio return. So this result is when we have 50% invested in Apple and 50% invested in Google. Now we have to, to vary these proportions. For example, we can start by minus 0.5. Which is a short sale of Apple. Short sale of Apple. As if we will, short sale Apple. بيع المكشوف يعني. Get money, add this money to our initial wealth, and invest all the new budget on Google. مثلا واحد عنده $100,000 قام باع ابل بالمكشوف $50,000 ضاف مع $100,000 اللي عنده صار عنده كام؟ حطهم في جوجل كله. هذا ايش معنى نيجاتيف بروبورشن؟ شورت سيل. لما تلاقي بوزيتيف بروبورشن يعني لونج سيل. طيب then we propose to add or to increase the proportion by an increment of 0.1. كمان نزيده 0.1. So equal plus 0.1. Then scroll it down. حطينا أول شيء minus 0.5 صح ولا؟ بعدها حطينا اللي قبله plus 0.1. أبصر حط مثلا minus 0.4 بس واسحب عليه. See, so from minus 0.5 to 1.5, from a short sale of Apple to a short sale of Google. Then select all the table here. Then go to data table. Data. what if analysis, data table. Now, as you can clearly see here, we are modifying the portion of Apple. صح ولا؟ هاي اللي جالسين نغير فيها. كم استثمرنا في Apple؟ يعني في الكولن عندنا row input cell column input cell. So we'll use the column input cell. التغييرات اللي عندنا في العمود، عمود Apple. واللي بنغيره هو 0.5 هذه اللي اخذناها كبدايه، هي اللي بنغيرها. نرجع مره ثانيه نسويها. نشيل كل شيء. So we have to select all the table. So what is our goal? Our goal is to compute for each one of these proportions the portfolio standard deviation and the portfolio average return. صح؟ هذا هو هدف. The first two values here were obtained when we have 50% invested in Apple. صح ولا؟ الحين نريد نعرف شو بيتغير البرفورمانس حق البورتفوليو لما نستثمر مثلا 0.2 في ابل او 0.5 ومره استثمرنا 0.9 ومره 1.3 او نعيد الحركه هذه كل مره بالداتا تايب تعطينا مباشره. بس احنا شو نقول؟ يعني كان بنقول الاكسل استعمل يا اكسل نفس الفانكشن اللي استعملتها هنا عشان تطلع 8.16 1.183 لما استعملنا 0.5 وغيرنا 0.5 مره كل مره غيرها اعتمادنا على الفاليوز اللي عندك هنا في العمود هذا. ايش معنى داتا تيبل؟ احنا اعطيناه هدف طلع لنا كل مره ستاندرد ديفيشن والافريج مع تغيير او ناجم عن تغيير في البروبورشن هذول. فاحنا شو نسوي؟ نسوي سيلكشن الكل تيبل go to what if analysis data table. See, so we have two options. When you see row input cell as if, you will make the modifications or the variation in the row. Column input cell, the variation will be on the column. احنا وش راح نغيره هنا؟ وش اللي جالسين نغير فيه كل مره؟ الويت. صح ولا؟ الويت موجود فين الويت؟ في الصف ولا في العمود؟ في العمود. حط هنا column input cell. طب وش الفاليو استعملها اول مره؟ خلينا فاضي فعلا. يعني كنا نقول الاكسل احنا ما نستعمل انبوت سيل الرو، نستعمل بس الكولم. طيب وش راح نغير؟ يعني وش بدينا اول مره؟ 0.5 صح ولا؟ نروح على 0.5 يعني استعملنا في ابل اول مره شفتوها؟ بعدين اوكي. automatically Excel will update the results for the standard deviation and the average return for the portfolio for each one of these possible proportions invested in Apple. And transform these into percentage, for example. معانا في الخط. طيب اللي بعده الحين so we can build what we call the efficient frontier اللي اعطاها جابها جون ماركوفيتش. So Markovitch has proposed efficient frontier which is the set of points that represents the best possible combination ever. احنا نقدر نلعب الحين بابل وجوجل ممكن نطلع الاف الكومبينيشن، الاف يعني التوليفات صح ولا؟ بس من كل كويسات. في جزء واحد بس كويس هو efficient frontier شفتوها في البورتفوليو مانجمنت. شو نطلعها هذه؟ سوينا سيلكت الكل عنها هذول صح؟ عشان ذكرت عليكم نبدا بالستاندرد ديفيشن اول اللي هي في الاكس اكسس والافريج في الريتيرن في الواي اكسس. go to insert recommend charts scatter نرجع شوي كنا في home هنا نروح على insert. So first you have to select all the possible standard deviation and average return for the portfolio. Once you have done this, you go to insert, you go to recommended charts, then you go to scatter, then you click on it. بس هذا هو. And this is the shape of the Markovitch efficient frontier that you have examined or studied into the portfolio management course. Now, what are the most efficient combinations according to this, to this chart? وش التوليفات في البورتفوليو، احسن توليفات بين ابل وجوجل تعطينا احسن بورتفوليو. عفوا. Hmm? 8% مثلا هذا فكر. شوف لاحظوا معي هنا. This is a parabole. We call it a parabole. And there are two parts. So we have the blue lines. شفتوا هذه the blue lines. We have two parts. And we have an inflection point. في نقطة تحول هنا. هنا شفتوا تتغير نازلة تحت. قبل كانت مرتفعة هنا an increasing relationship. شفتوا هنا هذا نقطة تحول هنا من 8% وهنا في نقطة صار نزول. We call it inflection point. نقطة تحول. So all the points inside the parabole هنا داخل البارابول هاي are inefficient. مو كويسين. All the points outside the parabole sorry cannot be achieved. ما نقدر نسويهم، ما نقدر نوصلهم لأنه عندنا اسمه عندنا constraints، عندنا حدود يعني في التمويل. The most efficient points are on the upper part of the blue parabole. في البارابول هذه عندنا جزئين صح ولا؟ عندنا جزء أعلى جزء أسفل. Okay, so suppose we want to build a portfolio with risk of 10%, with standard deviation of 10%. صح؟ وين 10%؟ موجودة هنا صح ولا 10%؟ هذه هي standard deviation. So for this 10%, we have two possibilities. We have this first point here, شفتوه? And this second point here. Both of them have a 10% risk, but which one of them is the most efficient?
The highest return, which is upper.
The upper one. Why? Because for the same risk, you will receive a higher return. So why would you accept a 10% risk with minus 0.5% of return? What you can have the same, you bear the same risk, but you can gain plus 2% of return. So see, every point here in the upper part has a symmetric point on this lower part. And واحد يقابله في الجهة الثانية. But when you compare between both of them, all the points on the lower part of the graph will give you the same risk, but with lower return than the symmetric point on the upper part. So any smart investor, any rational investor will choose higher return with the same risk. That's why your efficient frontier is the one starting from this inflection point and going up. So this is the upper part of the Markovitch frontier. Okay, guys. Now there's a particular point, which is the inflection point. The inflection point is called the minimum variance portfolio. This is the minimum risk you can get here, 8%. The minimum risk. For 8%, you earn practically almost 1% of return. Every point on the Markovitch frontier is associated with a higher risk. The safest portfolio is this one. The safest one, right? With 8.13% exactly of standard deviation and 0.9% of return. We call it the minimum variance portfolio. Now, as investors, how will you choose the right combination? It depends on your risk aversion or risk tolerance. If you are extremely fearful from the risk, if you experience an extreme fear from the risk, عندك خوف مبالغ فيه, phobia من المخاطر, you will choose automatically the minimum variance portfolio. Every time you become more tolerant to the risk, you will move to the right hand side of the graph. تروح على اليمين, فوق على اليمين. لأن في البوينت هذا تلاحظ معي كل ما رحنا هنا وش يصير؟ الريسك بيعلى والريتيرن وش كمان؟ بيعلى. So it depends on your risk aversion, on your risk preference. You accept the risk, you will be located in this part of the graph, on the right upper part of the graph. You are very averse to the risk, you will be here. You are extremely averse to the risk, you will get the minimum variance portfolio because you no longer, interested about a return, but you are interested more about reducing your risk. Okay, so this is how we can interpret, the Markovitch frontier, efficient frontier, and how we can locate, our portfolio according to our risk tolerance or risk preference. Highest return وين هذا؟ لا ترى في الفرونتير حق الماركوفيتش يا ياسر ما تنتهي هنا لسه متواصله ما توقف. لانه احنا اخترنا 1.5 لنا، شفت هنا اخترنا 1.5. لو كنا رحنا بزياده كبرنا 2.5 و3 ما توقف. بس وين حدودها على اليسار، حدودها هنا في المينيمم فاريس بورتفوليو. بس من الجهه الثانيه ده منك ما تخاف من المخاطره دلع نفسك. ولو تكون بالعكس تصير مضارب يعني او تصير يعني مقامر، بالعكس تلاقيك يعني مره رحت على اليمين. يعني ما عنده حدود على اليمين، حدها بس على اليسار في المينيمم فارينس. واضحين ولا لا؟ يعني وين 1.5 ايش معنى 1.5؟ يعني انت الحين قول مثلا عندك $10,000 شايف بيهم ابل، اتفقنا؟ ولسه ودك تحط فلوس اكثر في ابل، عندك ثقه في ابل رهيبه، بس حط فلوسك كلها خلاص ما عندك فلوس، وش تسوي؟ تسوي بيع على المكشوف لجوجل. على المكشوف، ايش معنى بيع على المكشوف؟ يعني تبيع جوجل وهي لسه ما عندك، تبيع جوجل لسه ما عندك جوجل. شو يعني؟ ببيعها لشخص ثاني خلاص، خلي بالك جوجل $5,000 بما قيمه $5,000 اسهم جوجل، بس بسلمك بعد شهر مثلا. بالضبط، هي تقريبا نفس البورنج، انك بتصرف فلوس بس مو عن طريق البنك، عن طريق البيع على المكشوف. حلو، صار عندك كم عندك فلوس؟ صارت $10,000 ثروتك الاساسيه، و5,000 البيع على المكشوف بجوجل، صح ولا لا؟ صار عندك كام؟ 15,000 يساوون كام؟ 150% او 1.5 من ثروتك الاساسيه. ايش معنى 1.5؟ يعني you are extremely interested in Apple, so we'll accept to short sell Google, add the money to your initial wealth and then invest all this budget into Apple. And the other part, the opposite part, عندك minus 0.5. Here, you are no longer interested in Apple, you are interested in Google. So you will short sell Apple for 50%, then add this, cash flow to your initial wealth, and then invest the whole thing into Google. بس هذا ايش معنى 1.5 و minus 0.5. اتفقنا؟ طيب, the final thing. So next time we'll see how to build a portfolio with n assets, but I prefer to do it independently during the next class because it's a little bit more complicated. Now we'll try to practice what you have seen right now. So I will share with you the stock prices for two shares, and you have to build the efficient portfolio using Markovich assumptions. So this is the هذا هو. So I have Kellogg and IBM, two US listed market. I have annual prices, not monthly prices, annual prices from the year 92 to the year 2012. So almost, I think, 11 years. No, sorry, 21 years, right? So you have first to characterize IBM and Kellogg stocks, which means identify their average, standard deviation, and variance, and covariance and correlation, and then build a portfolio using Kellogg and IBM, and then build the chart of the efficient frontier. يلا برسوا الحين عندكم على وشو؟ حطوا اللي تبون انتم. اختار الوقت اللي تبيه وبعدين بس في الاخر تلاقوا نفس فرونتير. برسوا الحين اللي سوينا الحين يعني برسوا الاثنين، برسل لكم اللي صحناه الحين والاكسرسايز هذا.
هذا تسليمه في الايميل؟
لا نسوي الحين هذا. اي بسرعه كذا. ما البروجكت عندنا البروجكت عندنا ما ادري عاد. ودرجتكم انا صراحه ما كنت تعبان شوي، ما صحت بس 3 فايلز يعني. درجة كويسة يعني نوعا ما، مو بذاك السوء يعني.
لا ما the bonus is not نسوي الافرج والفاريانس والستاندرد ديفيشن
قبل كل شيء so you have to transform the prices into returns because these are the prices, the stock prices.
لا تغششنا دكتور. نحسب الافرج والفاريانس والستاندرد ديفيشن.
بس لكم الحين اشتغلنا الحين ليش اشتغلنا سووا بالضبط بس. chapter 8 template هذا drop So we have 15 minutes, or let's say 20 minutes. So we don't have to, to compute the covariance and correlation with different techniques. Just give me the right answer, whether using the statistical technique or Excel function.
بس نحسب البوبيوليشن هذا.
لا ده نحسبها سامبل. هنا سامبل. واضح؟ اشتغل على السامبل. هذا اللي سويناه الحين، حليناه الحين عشان تشتغلوا زيه يعني. And find standard deviation is simply the square root of all the variance. This is for the particular case when we invest 30% in Kellogg and 70% in IBM. Once again, let me remind you that you are free to choose whatever values you want. The most important one, you have to interrelate these two values or these two weights together. Now, we will build a data table. Let me just free these cells. So it's for the portfolio, standard deviation first, as I told you, and then the average. So the X variable here is standard deviation and the Y variable is the average return. First row, you have to, repeat standard deviation and the average return we have computed right now. So standard deviation is here, see, the cell J20, and the average of the portfolio just computed a few seconds ago, the average. So these two numbers were computed when we invest 30% in Kellogg and 70% in IBM. Now we have to vary these proportions. So I can start, for example, from -0.8 and add 0.1 each time. So 0.7. Sorry. Then I will select these two numbers, then scroll it down until reaching, for example, 2. Now I will select the table, go to data, then what if analysis, then data table. So the row input cell. So we're not interested in, we're interested into the column input cell because our proportion are varying into the column. So the first or the initial, weight is 0.3. So J15, click on OK, and that's it. Sorry. Now you can select the standard deviation and the average, different values here. See? This one, let me just put this one into percentage formula. Then go to insert, then recommended charts, then the scatter. And this is our efficient frontier. If I want to add axis titles, for example, here for the horizontal, I will add portfolio. Sorry, here this one. portfolio standard deviation. Can also add, so one is portfolio return, and we can efficient frontier. See, so the good thing here, see guys, when you invest all your money in Kellogg, see, you expect to have a return of 5.6%, right? And a risk of 18.73%. Now, thanks to the diversification, the portfolio displays the same level of risk, almost 18.88%. See, 18.73%, and almost the double of the return of Kellogg. It's a good thing with diversification. Now, IBM, for example, here is offering a higher return by, let's say, by 2% almost, right? But at the same time, IBM is exposing you to higher risk, 26% instead of just 18%. That's why, so this mix between Kellogg and IBM is very beneficial for the investor. Okay, any question, guys?
I was trying to find the optimal weight for these companies to obtain maximum return.
The optimum weight depends on your aversion to the risk or risk preference or your degree of the aversion risk, small a.
If I just want to maximize my return, would you ignoring that risk?
So you are no longer let's say a rational guy. If you ignore risk, you are no longer rational. But in such case, you have just to put all your money and short sale Kellogg as much as you can and invest all your budget into IBM.
Yes,
بس
I was trying using a solver.
ما توقف ما توقف ما عندك حدود انت. يعني في اسمه في الاسامبشن او الهايبوثيسيس حق ماركوفيتش يقول لك ما في حدود للشورت سيل.
اذا افترضت اني ما راح استخدم شورت سيل
100% IBM
100%
وبيعطيك اكثر عوائد.
فما في يعني وزن امثل دائما.
انت وش وضعك مع الريسك؟ انت ما يهمك الريسك، خلاص كلك IBM. مثلا يمكن محمد يخاف من الريسك، بيحط نفسه في المينيمم فارينس بورتفوليو اللي هو هذا مثلا تقريبا من 14.84% risk 7.47% of return. إذا نشوف هذا وين موجود، هذا بنلاقيه 14 هنا 70% كيلوج و30% IBM. فهمت الحين؟ طيب أسئلة ثانية؟
There is difference when you're using more than two companies. More than two.
This is absolutely. So we'll see it next time, inshallah. We can use with n assets, and n can be very big number, but fortunately with Excel we can solve it, easily. If you want to solve it using the traditional mathematical tool, we can spend days and days to do it. But the Excel, yes.
But want to know what is the portfolio risk return with different with more than two companies.
We'll see it inshallah next time. just record the assistance.